Welcome to this explainer on the structural shifts that are rapidly maturing the private equity industry as we move through 2026. Look, if you're actively operating in this space, you already know the landscape has fundamentally changed. So today, we're going to bypass all the noise and look directly at the data to map out this new terrain. We're zeroing in on the highly technical, operational environment that absolutely defines top-tier performance right now.
Here is exactly what we'll be covering. First, the 2025 deal-making rebound. Second, the persistent liquidity backlog. Third, AI-driven deal sourcing. Fourth, operational value creation demands. And finally, the new fundraising reality. Let's jump right into Part 1, the 2025 deal-making rebound.
Global buyout deal-making value surged by a massive 20% in 2025. We're talking nearly $1.8 trillion, which effectively eclipses the 2021 total for mega deals, meaning transactions over $500 million. So the market for deployment is definitively open, with larger fund managers driving a huge resurgence in transaction value, even with a slight drop in the overall deal count. But that aggressive deployment is immediately hitting a massive bottleneck. The average holding period for a portfolio company has stretched to an unprecedented 6.6 years. So while we're seeing massive capital being deployed on the front end, portfolio velocity has slowed to a crawl. This fundamentally alters how we have to model hold periods and exit timelines. The McKinsey Global Private Markets Report perfectly summarizes this reality. They note that while the private equity weather has improved, it's revealed much more demanding technical ground. Basically, the fog has burned off, deal-making is back, but the terrain underneath requires a highly disciplined approach to alpha generation. The days of easy macroeconomic tailwinds, they're gone.
And geographically, this rebound is sharply diverging. North America is the primary engine right now, driving buyout value growth up 29%. Meanwhile, Europe saw a much more modest 8% increase, and the Asia-Pacific region actually contracted by 3%. We're seeing capital increasingly concentrate in markets that are perceived to offer the highest quality assets and the most transparent regulatory environments.
Which brings us to Part 2, the persistent liquidity backlog.
The sheer scale of this inventory bottleneck is honestly staggering. 52% of all buyout-backed inventory has been held for over 4 years. That's more than 16,000 companies globally just aging on the books. It's the highest level on record, and it's a direct hangover from the exuberant deal-making we saw back in 2021.
Because of that backlog, cash outflows are at historic lows. The 5-year rolling DPI hit a record low of 10% in mid-2025. For LPs, DPI is now tied with MOIC as the second most important metric shaping their allocations. They desperately need liquidity. As a result, we're seeing an explosive 48% growth in the secondaries market, hitting $240 billion, as GPs and LPs literally force liquidity. But there is a catch here. As these mature portfolios come to market, average buyout pricing in secondaries has dropped to 92% of NAV.
Moving on to Part 3, AI-driven deal sourcing.
To navigate this backlog in a persistent high-multiple environment, you simply cannot rely on traditional origination anymore. The 2024 Syndex report establishes a really critical baseline here, noting that AI is no longer just an adjunct tool for cleaning up data rooms or doing back-office reporting. It is moving into enterprise-scale transformations. It's the new epicenter for uncovering proprietary market signals way before an asset even hits a banker's desk.
Platforms like Syndex Finder are revolutionizing the space by leveraging machine learning and natural language processing to ingest massive, incredibly diverse data sets. The goal isn't just screening. It's about detecting early market signals and actually predicting which companies will need to raise capital or seek an exit in the next 6 months. This lets sponsors preempt highly competitive auction processes entirely. Armed with these advanced AI tools, sponsors are fundamentally changing their targets and running straight toward complexity. We saw a massive 43% surge in global take-privates as firms recognize that public markets might be undervaluing certain assets. Dealmakers are also laser-focused on specific sectors right now. Healthcare is up 173%, and energy is up 70% for megadeals. They are specifically hunting for targets that possess verifiable data moats that can be massively scaled using AI.
Now for Part 4, operational value creation demands.
Sourcing is only half the battle. Once the asset is in the portfolio, we're seeing perhaps the most critical shift in the industry. The traditional tailwinds of cheap leverage and multiple expansion, they're dead. Historically, those levers accounted for nearly 60% of returns. Today, we're looking at median entry multiples of 11.8x EBITDA. with debt contributing a much lower 37% to that multiple. Under these specific conditions, pure operational alpha is mandatory. You literally cannot financially engineer your way to a 20% IRR anymore.
And the market is actively rewarding this pressure through specialization. When you compare specialist buyout funds to generalists, the numbers speak for themselves. Specialists are delivering a 17% IRR versus 13% for generalists. But the most crucial part? Specialists are driving 43% of their equity value strictly from EBITDA margin expansion, compared to just 10% for generalists. Deep sector expertise is proving to be a highly resilient, far less market-dependent return profile.
Inside those portfolios, leading operators are executing what we call AI-ifying the business well ahead of exit. Rather than treating AI as some marketing buzzword, sponsors are re-underwriting their portfolios, embedding AI directly into pricing models, sales productivity, and back-office automation. The goal is to institutionalize these productivity gains. That way, when it's time to sell, the buyer sees a verifiable, sustainable margin profile that easily supports a premium exit valuation.
Finally, let's look at Part 5, the new fundraising reality.
When we look at how all these structural shifts culminate at a macro level, core closed-end fundraising appears depressed, down 17% globally to $616 billion. But that actually obscures a highly bifurcated reality. North America grew by 8%, while Europe fell by 41% and APAC plunged 49%. What's truly notable is that capital is heavily favoring established, mega-cap GPs with proven track records. First-time funds are sitting at a decade low. The door for new entrants has narrowed materially.
However, if we look past just traditional closed-end funds, the real capital shift becomes incredibly clear. Alternative and semi-liquid retail structures are absolutely exploding. In the US alone, retail capital flowing into these alternative structures doubled to $204 billion in just 1 year. This is being driven by structural regulatory reforms around defined contribution and pension plans. It's forcing GPs to build entirely new distribution channels and liquidity management capabilities just to tap into this massive retail pipeline.
Now, despite muted returns relative to recent public equity performance, LP conviction remains fully intact. 70% of LPs plan to either maintain or increase their private equity allocations in 2026, but they are aggressively sorting managers. It's a flight to scale, specialization, and GPs who have a proven ability to actually deliver DPI. This intense pressure is accelerating GP consolidation, pushing asset manager M&A deal value to $34 billion. Ultimately, LPs want platforms that are genuinely equipped to navigate these highly technical conditions.
As we look forward into 2026 and beyond, this market is no longer about timing the cycle or riding macroeconomic tailwinds. Alpha must be made, not found. So the ultimate question for GPs navigating this mature, highly technical market structure is simply this. Do you have the scale, the AI-integrated sourcing, and the specialized operational capabilities to deliver real liquidity? Is your vehicle built for this terrain?